Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 23rd of 2025. Focus our attention first here on the investment markets, particularly the equity markets, which have really struggled to find their footing here in the wake of tariff announcements and policy uncertainty with regard to the federal government. You can see here that we have had a notable stress. We have had notable stress on the equity markets year to date. You can see year-to-date returns for the major indices here have all been negative. You can see the index maximum drawdown from their year-to-date high has all been almost double digits. The only one of these four indices here that has not been in an official correction would be the Dow Jones at -9%. But you can see internally within these indices that the average member or constituent company within these indices have been down a lot more than the overall index has. And in particular, when we talk about these three right here, which have more of a tech focus, you can see in the S&P 500's case here that the average member has witnessed a 15% drawdown from its year-to-date high, and NASDAQ more than double that, as a matter of fact. And then Russell 2000 represents small caps, and we've seen some notable drawdowns in the average constituent member in the Russell 2000. And we know that the Russell 2000 has a lot of members that frankly are not even profitable, and so those you would expect in a equity stressed or high volatility period would be particularly exposed in that environment. And then Dow Jones, which not nearly as broad as the S&P 500, but focusing on the industrials, kind of companies that tend to have more cash flow, pay dividends, things like that. Those have largely been much more insulated on an average basis, and then as we just discussed, on an overall index basis as well. But they've all been negative for the year. Again, just not sugarcoating the fact that the equity markets have had a real tough slog here in the wake of the rollout of the Trump administration. Interesting chart here. Have a few of these from Apollo and Torsten Slok. He's their chief strategist, economist there at Apollo, does some really good work. Here we have kind of a breakout of consumer staples and consumer discretionary. So this I show you as an exhibit of why the policy uncertainty and everything out there that's causing anxiety is having an impact on consumer discretionary spending, which is highlighted in this blue line. So this is really the S&P 500 stocks that are in this particular GICS category or particular industry category. And so those stocks have been selling off at a much greater clip have been the consumer staples, which you think about Kimberly-Clark and those people where demand is going to be a little bit more insulated, and demand is going to be a little bit more inelastic in a sense, because everyone's going to need Kleenexes, everyone's going to need toilet paper, everyone's going to need some of these things that we have in our daily lives that we must have. Now, discretionary inherently are items that we could do without if we had to. And so naturally, you can see that there's more stress there in that particular category than some of the others. Here we have a couple of charts here from Deutsche Bank. Just real interesting. We talked about concentration risk and the fact that the S&P 500 has become much more of a technology index. And you can see here, going back to 1970, we had the share of the top 5 companies by market cap was up around 25%. But back then you could see, you could argue AT&T was more of a telecom and more of a utility back in 1970 than it was ever a technology company. But IBM certainly a tech company. But you see Kodak, Exxon, a wide variety here. And then we had a period where the Nifty 50 here was in vogue. And so you had these concentrations which declined over time and eventually got down to a low point in 1995, but that was then subsequently followed by the dot-com era, which we had some of these companies that had extraordinarily high multiples really take form here and witness massive price gains. And then, so that's mitigated over time, but here we are in this rarefied air now, particularly, you go back to 25% in 1970 through 19, call it 1972-ish. And, we're pushing almost 30%. And these are all really technology companies, if you will. Apple might be more of a consumer discretionary to some degree, but and as Amazon is too. But clearly you can see the divergence here. Clearly you can see, what has transpired in the construction and the evolution of the S&P 500 index. Another slide here from a report that talks about looks at historical backdrops. So basically, we're looking in this kind of light blue line. We've got 2019 to 2024. And so this is the top 5 tech companies. Again, not just the top 5, but very specifically the top 5 tech companies, average 12-month forward price to earnings multiple. And so we talk about valuation differentials being out of whack. And of course, 30 times is very robust. And that's basically where we are on an average basis if you look at peak multiples as they stand right now. And then in the dark blue, we have what that looked like back from 1997 to 2002. Again, the tech bubble. So you can see that these the x-axis here has been split into these 2 categories. And so we lay these on top of each other to get a sense of perspective of where we stand relative to that really amazing period of time back in the tech bubble. It was great while it lasted, but then it was really terrible after the tech bubble burst. And you can see at its peak, we had tremendous multiples here that we haven't, frankly, gotten back to, even though we've had this massive surge in concentration risk and we've had this, rather dramatic surge in overall prices. We just haven't gotten back to that excess point from the late 1990s. Here we have a chart that we've shown you with regard to trade policy uncertainty. We know we've seen this several times. It's spiked. But what's interesting, this is some research out of Fidelity. And so oddly enough, when you have periods of high trade policy uncertainty, again, this is just what the data tells us, that you have ultra high policy uncertainty, you tend to have expansions in your Sharpe ratio, which is a measure of risk-adjusted return. So you tend to have periods where you get relatively good returns at points where you have high policy uncertainty. It seems somewhat counterintuitive, but this is actually what the data tells us. It's not to say that we're going to have this market turn around on a dime here, but just generally speaking, when you look at Sharpe ratios, which are basically a risk-adjusted return, and when you're at high policy uncertainty, that tends to be higher. Very interesting. Another thing that is pretty interesting here is the calculation, the mathematics behind like taking consumer prices and subtracting producer prices. So this is a CPI, consumer price index, minus the PPI, producer price index. And so this delta has been positive for some time. And so when you have that, when you think about companies that are selling to consumers, if you have high consumer inflation, that means that these sellers have pricing power and they're getting price out of consumers. And so if your costs are less than what you're selling it for, then ostensibly it sets the table for higher profit margins. And this is the argument. This is another chart from Fidelity. This is the argument that they're actually making, is that in this uncertain environment, you could actually have the formations of what we would call a continuation of margin expansion or for strong operating margins on the part of publicly traded companies. So we go back to some charts from Apollo. Something I've shown you intermittently in the past is, and something that's pretty well understood now. We have a pretty high foreign ownership of U.S. stocks, and that continues to rise. And this is actually measured in trillions of dollars. So this is real money and real significant money at that. And then here's conversely, U.S. holdings of foreign stocks has been call it flatlined and maybe slightly up over a period of months here. And of course, this data series goes back to 2019, so it gives us roughly about 5 years worth of data, more or less. But you can see that foreign ownership really began to take off in 2022 when we had kind of a low point in the market before it began to recover again. You can see that that concentration has only expanded over time. So what are the implications here? You know, if we obviously if we continue to make everybody mad across the world with our call it fiscal and trade policy, then you know, maybe that can reverse, but the dollar's been relatively strong. So there's still going to be demand, I think, for U.S. equities, regardless of what the geopolitical tension backdrop looks like. Something else that has been evolving as of late, you can see this kind of like turn down. This is basically the differential between the S&P 500 valuations and international, and you can see that that has dropped off considerably, meaning that international stocks have become better valued relative to the S&P 500, even though there's a massive valuation differential that persists with regard to international stocks, meaning that international stocks are trading at a significant discount to U.S. stocks, but that differential is beginning to reverse. And we saw multiple years where that just continued to expand. And there was a huge value proposition that emerged in 22 and just kept getting more and more acute as we went. Now that's beginning to turn around a bit. So this is kind of like following in the thesis that we've always had, that diversification into foreign stocks has been, you know, and should be considered. Granted, you know, we haven't had lots of opportunities for catalysts to emerge for that valuation differential to be realized, but now with trade policy uncertainty, that's proving to be a catalyst here for better price action out of international stocks. Here we have equity analyst net revisions. Not too surprisingly, with all the uncertainty out there, we've had a pretty big shift here lately in those estimates, and that really goes back to when the Trump administration took over, and we had a brief kind of period of optimism where we felt like, okay, less regulation, et cetera, might be helpful, and I think it still will be an offset at some point, but the anxiety and trade policy uncertainty is causing analysts to really change their estimates, which honestly I think is a good thing. I think this kind of catharsis here and maybe a capitulation of sorts is going to collectively get us to a point where you know, we're more likely to beat estimates than we are to underwhelm them. Here we have an educational piece. This is you know, a very interesting case study in compounding, and so let's just kind of set the stage. So we got three graphs here. The first one looks at 5 years, second one looks at 20 years, and the third one looks at 50 years. And we always talk about investment horizons with our clients. And you know, you know, I'd say most people probably fall in the 20-year category, even though they feel like they're, you know, because they're watching their balances every day and they get caught up in the day-to-day stuff. And you know, really, I mean, most people don't have 5-year investment horizons. But Having said that, we live in a world where, as we just talked about, where valuations are higher. So this is a study that says in all three cases, we have a price to earnings ratio that falls basically about 25%, from 25 times to 19 times, which gets us a lot closer to our long-term average. So what if the valuation of the market drops 24%? But we're continuing to invest and we're continuing to have faith in the long-term viability of the market. This is a really good chart for that. So this chart assumes that stocks are going to grow at 11% per annum. They're going to grow at 11% regardless of, just in a straight line, in this case, compounded manner. But here we have the impact of the PE ratio falling. So if it falls, from 25 to 19 times, or about 24%, that's about 5.3% on an annualized basis. Now, if we didn't have that drop, then we would have this kind of price gain in stocks. But even with this valuation drop of the market, the multiple contraction, we are still able to grow between year 0 and year 5, 28% in overall prices, even with the multiple contraction, and that comes out to about 5% per annum. Now, if we have a longer term goal, if you kind of basically annualize, a 24% drop in your PE multiple over 20 years, that's only about 1.4% per year. And so even with that multiple contraction, you're still able to grow this index by 513% over 20 years. And again, this is what most people have as an investment horizon. If you're diligent and you don't succumb to emotional biases, you don't try to time the market, you just remain steadfast in a market that may be a little overvalued now, but you're still achieving a 9.5% gain. Again, you're not going to get 11% because you've had multiple contraction, but you're going to get 9.5%, which is going to make almost every financial plan work if that's the case. And then even more so if you have a 50-year horizon. In this case, I'm really speaking to the 20-something-year-olds that really are getting started in their careers. And again, the power of compounding in this chart is really, really strong, even if you have multiple contraction from today's valuations. Here we have some charts on dividends and buybacks, and just the power of dividends, which we know over the last 40 years or so have accounted for about 40% of the total return. This is charting both dividends and share repurchase activity. You can see share repurchase activity has really picked up in the last decade, but so have dividend payments. And so this has accounted for a lot of the return in the index, and we still believe in this. This black line represents the proportion of total activity that's accounted for by buybacks, and it's been fairly steady at about 60% of the total activity. So they're returning money to shareholders both in the form of buybacks as well as dividends. Now, we look at dividend changes at U.S. companies. You can see that that's been fairly steady, and even though we've had maybe a couple of years worth of upticks in dividend decreases, that by and large we've had some companies that have remained fairly static here, and that maybe if you look at it over a long period of time, maybe perhaps slightly increased use of dividends. But when they change their dividend policy, they're much more likely to increase their dividends than to decrease them. Another chart that we've shown you several times, here's Goldman Sachs. We've got investor allocation equities at an all-time high, 51%. You can see debt has gone down. Some of that has to do with the fact that debt has itself proven to be more volatile. In some stretches back in 2022, debt was actually more volatile than the equity market was. And then cash, you can see, is about 14% And this is asset allocation across households, mutual funds, pensions, and the foreign investors, which we have mentioned are very important in our markets these days. So having said that, obviously we pointed out in the first slide that we've had negative price action in the markets this year, and as a result, consumers are going to, and U.S. households more specifically for this definition, are set to have a fairly sizable multi-trillion-dollar wealth drop because of the decline in equities and because we have more people in the equity market and we've got more people in equities overall. And so this is a painful observation here in the sense that it does influence consumer behavior. So if your net worth drops, and again, this is a pretty sizable figure here, that it could influence behavior in consumer spending and some of these other areas, which are obviously very important to overall economic growth. Here we have a chart from Macrobond, pretty interesting here. So that basically we've indexed the S&P 500 to February 19th, and that's kind of basically where the top was in the market. And so what happens to the market going from here? Now, people are talking about recession. I'm not convinced that there is a recession in the cards, but there's clearly a slowdown at work here. Now, if the market doesn't go into slowdown, again, from February 19th, if it doesn't go into, if it doesn't go into recession, then there's a high propensity of stocks to rally at some point. Then we get oversold and then stocks pick back up. Now, if we go into recession, history tells us that stocks are apt to continue to sell off. And but we've already seen a large part of that dislocation here. So again, we don't know where this is going to go. Some data here over the last week or so with regard to productivity and some other variables may keep us, flat in terms of economic growth for the first quarter. The Atlanta GDP now is still negative, but it's not down as much as it was a couple of weeks ago. So we'll just have to wait and see. Now, kind of this informal accepted definition of a recession is 2 straight quarters of negative economic growth. And so obviously if we get a negative economic growth in the first quarter, then all eyes are going to be on 2Q to see how that goes. But again, too early to tell right now, but we're obviously watching things very closely. Here we have the AAII, the American Association of Individual Investors, bull-bear spread. So very low. Investors are very bearish right now. In fact, on looking at it from a consecutive week standpoint, I mean, we're at 55 now. And this is, this is, as I've used this term before, rarefied air, that rarely have we seen this much pessimism coming out of the individual investor arena, as we are right now. So this is very bearish thought. Now, the upside to this is that at some point you get capitulation and you get kind of a flush out on the market, and maybe that takes us down another 5% in the equity indices. But it flushes out this negative sentiment. And then you get to the point that I mentioned in the last slide where you've bottomed out and you get that rally. And of course, some of that's going to depend on data. I think everyone's sitting on pins and needles right now. And obviously, investors that are looking at their net worth fall. This is kind of a self-fulfilling data point here, or what we call like, serial correlation, that it happens because of something else, that your valuations go down, so naturally you're getting more bearish, and that kind of, it's a feeding frenzy there. But at some point you wash out and markets go back up again. So we're still talking about tariffs. I saw this in a chart from again from Apollo, and so it just shows areas of the world that already have pretty high standing tariff rates in the dark green. But again, let's not fool ourselves that tariffs are a common thing around the world. And it's not like, we're deliberating over increase in tariffs. It's not like we're instituting them for the first time. And we obviously know 2018, 19, during Trump 1.0, that we ramped up our tariffs. But let's be clear that tariffs are very widespread across the world. And, as we look at the relative tariff rates, you can see here that, in some parts of the world, particularly like South America and Africa, and then India too, that those tariff rates are very high already. And if nothing else, what U.S. is doing is kind of catching up to that. But it seems pretty visceral because we've always promoted free trade until really just a handful of years ago. Couple of comments here before we get into the consumer. We've got occupancy rates, which, looking at a broad swath of markets, have really leveled out. And so this slide is kind of categorizing that at about 55% of what 2019 looked like. So if this is where we settle out, at least we can get some planning in place for office capacity and new construction and so on and so forth. It's just that we haven't really known where this is going to level out at. And for a long time, there was a lot of skittishness and banks weren't lending on it unless you had a 50% pre-leased tenant. And obviously a lot of people were uncertain as to the stay-at-home environment. And as we'll see in the next slide, that seems to have settled out a little bit now. So again, maybe some stability in the offing for the office market. Now, I know we do have a debt cliff for a lot of people that have debt related to office investments, and they'll obviously have to be able to roll that debt over. So we may have some defaults there, but at least the new normal seems to be beginning to show itself. Consumer sentiment is declining. We know that. We've talked about that already. Investor sentiment is pretty low, as we saw in that AAII. That tends to bleed over and correlate to the consumer market. And interestingly enough, it's affecting both of the major cohorts. That we have families in the green here with incomes greater than 100,000, as well as in the blue with income less than 100,000 per year. That we see same trends there. So we have cumulative excess income, which we've shown this chart before. The top 10% of earners still have a lot of savings in the bank, and we do know that they tend to do about 50% of the spending. And so this gives me a lot of comfort here, even if the bottom 9%, 90%, they continue to whittle away at their excess savings. And again, this is indexed back to the declaration of the pandemic. So their level of savings or excess savings is still higher than it was than when at the advent of the pandemic. It's just a lot less than where it was kind of before we hit peak inflation. And then households running out of emergency funds kind of falls in line with this trend here, that we've got decline of the probabilities in people coming up with $2,000 over the next month. That is down a little bit less than 2/3 of the population. So consumers think business conditions are worsening, and that's evidenced by the spike here. Again, policy uncertainty, trade uncertainty, tariffs being mentioned. A lot of what you read in the press is driving this. This is the view of what consumers think business conditions are going to look like in a year. And I'd say that this is actually a survey that asks them, do you think that conditions are worsening? And so that's why this is moving higher. So staying in line with the consumer here, we've got a 12-month expectations for unemployment. And very unsurprisingly, you see that this number is spiking because of a lot of the data points that I've already shown you with regard to the confidence in the economy growing and confidence in business conditions eroding and so on and so forth. So it very much seems to reason that they're also going to feel less optimistic about the labor markets. But as we talk about the labor markets, it's also important to talk about labor participation rates, and there's a lot of, I would say, unknown variables in this number, which is actually a very, very good number. So, and the uncertainty comes from immigration policy, and so we don't know how that's going to influence these things. But this is a participation rate of really peak earnings years between ages 25 and 54. And that number right now sits at 83.5%, which is extraordinarily high in a data series that goes back to 2007. And honestly, we haven't seen levels this high since really the 2007, 2008 level. So this is good. So in a sense, you have prime working age people that are in the market and have been getting in the market for for some time now, and if that's further exacerbated by immigration, although immigration tends to support more of the kind of the lower end service sector jobs, but not exclusively, it would tend to help support the notion that labor is going to remain fairly strong and tight, and that might even parlay into wages as well. So as we're following the consumer, we've already talked about expectations for economic growth, expectations for employment, so on and so forth. Here's a decline in expectations for household income, which have dropped off notably here, really even during 2024, but just accelerating into 2025. Pretty low point. I mean, this is the global financial crisis, and it's a lot of pessimism back then. But again, these things are inherently cyclical, so it did pick up over time, then dropped down in the pandemic, and then picked up again. And so again, not that this is going to represent another recession, because we don't know that yet. But consumer income expectations are a little bit lower. And ultimately, economic growth is determined by what consumers do, not how they feel. So it'll be interesting to see how they channel these income expectations into discretionary purchases, which we know are already, at least those market sectors are selling off right now because of charts just like this. If expectations are dropping, then maybe large ticket durable good purchases are going to fall off. And then, of course, that has all sorts of ramifications up through the value and supply and production chain. Here we have inflation expectations. We've already shown you iterations of this. This is just due to uncertainty, right? Tariffs, which can be inflationary in the short run. If sustained, they tend to suppress growth in the long run. But expectations, nevertheless, are moving higher for both the 12-month inflation expectation, that's the green line, and the blue line, which represents a longer term 5 to 10 year expectations. Here we have National Federation of Independent Business. This is small business expectations now. And so they are looking at the possibility of higher prices over the coming months. And, again, very unsurprisingly, we have tariffs. There are supply chain issues. Small companies are less able to insulate against that and more apt to try to pass those costs along to consumers. But again, we'll just have to wait and see. So we did get some regional Federal Reserve data last week. Is the Philly Fed Manufacturing Index, which I think is a really good proxy for what's going on. More broadly speaking, it's very consistent in the activity in these charts relative to some of these other consumer charts that we have. So again, the overall index still positive, but witnessing a pretty stout decline. Manufacturing outlook, which had been recovering for a number of years in the Philly Fed region, that has also declined. We've got new orders, so this is kind of more of a real-time manifestation of companies pulling back on their capital spending, and even in some cases operations to try to help preserve margins. So this is about as real data as you get. Actually, the current data is in the blue and the expectations are in the pink, but you can see both are dropping off their peak. Here we have Philly Fed prices paid. So again, a real-time manifestation of what's going on with the tariff regime. And just for grins to kind of, marry the Philly Fed data with the Empire State, which is New York. This is real data. So these are prices that are actually being paid. This one is moving in the same direction, but this is the expectations looking at over the next 6 months in an entirely different Federal Reserve district. And you can see that there's consistency between these. And as I've often caveated, we show a lot of the, Philly Fed, Richmond Fed, KC Fed, Dallas Fed, San Francisco. We show these different Fed districts, and there are differences between them because they're different industry components and constituencies. But, when you see expectations in one district, which dovetail and look very similar to increases in real-time prices paid in another district, it reinforces the notion of what's going on out there. Here we have some housing data. Actually, we have pretty healthy things, I guess, to report here. I mean, we've got in the green line, we've got 4.1 months of inventory on the market. This is per Redfin off of multiple listing service data. This is a national number. I know regions have their own subtleties to it, but again, a much stronger environment than we've seen in a number of years. Median asking price is up a little over 6.5% a year. You can see 423,500 is that median asking price, which again, we're pushing that delta relative to the last 3 years. Very interesting here, at a time where, consumers are feeling a little bit more stress and anticipating a little bit more stress economically. It kind of makes me think about how sustainable this is, and given that backdrop, because I do think it's going to lead to activity, even if mortgage rates have dropped because 10-year yields have dropped. The affordability issue is still compounded or confounded, I should say, by the fact that we've got these median asking prices that are up considerably year over year. Here we have CEOs weighing in on their feelings of confidence. And you can see CEOs are also in the same boat as consumers. I mean, they're a little less optimistic because of the uncertainty. Again, the uncertainty is driving all of this. And as I'm showing you in some of these slides, I mean, real prices paid are going up, and it is starting to impact capital decisions. Now the question is, how far is the Trump administration going to go to prosecute these tariffs? At what point does the slowdown in growth begin to kind of like change its tune, so to speak? But right now we've got CEOs that are less optimistic than they were. So for grins, I actually threw this in because I think this is powerful as well. Now, there's been a lot of rhetoric about the tariffs on Mexico and particularly Canada, and a lot of people scratched their heads, and I think with good reason. Why are we putting massive tariffs on Canada? What do they do? And this is actually the Canadian Federation of Independent Business. This is the CFIB business barometer. So this is Canada. You can see what that announcement has done to that particular index, and you can see how bleak and how just completely dislocated we were in COVID. Well, current conditions there from a sentiment index or sentiment basis are even worse than that now in Canada. So we got crude prices moving back up. This is Brent crude. We're over 72, approaching $73 a barrel, and do see prices moving higher a little bit. Obviously, there's going to be tariffs on energy too, because considering that we're exporting more energy. Now, the interesting thing here is something I caught in the research that really surprised me, and we've had a very notable rise in the expectations for production coming out of Alaska, which will help to temper price growth because of more increased supply. And, as Trump's, I guess, regardless of how you feel about Trump, the mantra there is drill, baby, drill, and that he is going to allow for more drilling, which will help increase production, which should help put more of a lid on prices and maybe promote more exports, perhaps at some point. I don't know that, but we've got energy prices that are really holding in here right now. Here we have a slide on solar. Why is this important? I just think that, over time, I think alternative energy sources for growing populations are going to be something that will have a pretty strong economic bearing on this country. And the interesting thing here is that there have been, annual estimates by the International Energy Agency as far as like their estimates for growth of solar capacity. And you can see that these lines are moving higher over time, but they're not terribly parabolic. And even as we get into 2017, 2018, 22 in this case, again, lazy estimates for growth, but the actual experience of solar capacity growth has been much more parabolic. And I think this is something that's not very well understood out there in the general public, and how the implications of this could be very helpful to energy use and overall energy costs and that whole basket, which impacts consumers greatly. You can see here global solar capacity moving considerably higher over the last several years, and expected to move even higher in the years to come. And the final comment here is just a survey that I saw in Bloomberg here of greatest retirement fears for workers that are in the market today. And, something that we see much more of, and again, all of these are relevant, and I just highlighted really the top four here, but, the ones that were over basically a third of all respondents, that you have basically health resonates here, declining health of you as the worker, health of, cognitive decline, dementia, Alzheimer's. I mean, that's all very important. Now, we didn't see these necessarily in the results, like 20 years ago. Outliving savings and investments. People are living longer, even if some have, health issues or cognitive decline. And then something that I think is likely to continue to move higher is that the risk of Social Security is taken away or it's reduced. I mean, it seems like everything else is being kind of thrown out with the bathwater right now with the Trump administration. So, there is a likelihood that this line increases, and it's the number of respondents that cites this as a risk. But then not able to meet needs, independence, isolated, and then downstream you get affordable housing. So all things that we as financial planners, we as investors should be aware of. And generally speaking, if you have these fears, these are things that run the risk of keeping you up at night, and that we should be working as professionals to try to help solve at least some of these problems. Now, we can't control cognitive decline, but we can certainly control like income in an environment where that prevents you as a worker from working. And obviously we can't prevent legislative changes in Social Security, but again, we can work on some of these other things and some of these other problems on this entire list, actually, to kind of help our clients over the long haul. That's all we have this week. I hope you've enjoyed the chart pack. We'll be back soon. Have a great week, and talk to you again.